It's the year of the wooden snake, and the wooden snake happens only every 60 years. What's going to happen this year, which is going to be a year of, I think, unremittent volatility. And that's all we've seen. We've seen volatility across all asset classes. And DeepSeek has added more uncertainty and volatility into what people thought was a sure thing, which is this generative AI trade. But I think generally speaking, the roller coaster ride, and of course you could argue, well, the stock markets ended January in pretty good shape, but it has been a meat grinder of a market, and it's been extremely volatile. I would expect that volatility to continue up until we get clarity on what trade policy is going to look like. I guess we'll find out very soon about 25% tariffs on Canada and Mexico, but we're not going to know till the back half of the year about fiscal policy. And that is the elephant in the room, especially in terms of what it means for the Fed and what it means for the Treasury market, interest rates, and then back to what it could mean for the stock market in terms of multiple contractions, so on and so forth. When you're taking a look at what globalization did to Canada, and you look at industrial production, manufacturing, employment, and output, it's far worse in Canada than it is in the United States. Canada got gutted by globalization more than the US did. Canada has an effective tariff rate of 1.7%. It's 2.5% in the United States. You know, Donald Trump points to Canada's bilateral trade surplus, but that whole trade surplus is in metals and minerals and energy and wood products, the stuff that America needs. It's all basically, that surplus is all basic material, which is Canada is the home of, rocks and trees. And there is no trade imbalance whatsoever in everything else. People say to me, well, how else is he going to pay for the tax cuts? He needs the tariff revenue. It's just too small. It all just doesn't really make any sense. I don't know if this is a message to China, which is that, look what we're going to do to our friends, and you're next. And 1% of the illegal fentanyl coming through the U.S. comes across the Canadian border. And that is a bigger problem with Mexico. And of course, an enormous problem with China. 90% of illegal firearms in Canada come north from the United States. I don't see Canada saying, well, we're going to slap on a big tariff on you. I don't know. Is this all Trump with his big, bold initiatives and the disruptor? Why he's coming after Canada and Mexico? And remember, Canada and the U.S. had a free trade agreement in the late 80s before Mexico showed up to the table. We basically all come from the British Empire. We have so much in common. There's no benefit to the U.S. economy whatsoever from these tariffs. And I'll just tell you that the risk is that he will plunge the U.S. into a recession, because I'm not so sure, despite all the smart people that he has, I mean, Besant, for example, how they don't understand that basically 50% of the U.S. automotive sector is reliant on the whole North American supply chain. Think of what's going to happen with these blanket tariffs if they come to fruition. To the manufacturing sector, it's going to be utter chaos. Think of the fact that at least a third of softwood lumber for the U.S. housing market comes from Canada, mostly British Columbia. Think of the impact that's going to have on the home building industry. So Donald Trump's going to roll the dice. I don't know how Canada's going to respond, but it's going to drive production and investment down. Canada and the United States will get crushed. And the problem is that everybody is so ingrained to believing that the business cycle has been repealed. This is actually a very big deal. And I don't find that, despite, and some of these people in his cabinet, they're smart, but it seems to be ideological and very protectionist in nature. They seem to think these tariffs will cause an inflow of investment into the United States. Before that ever happens, there's going to be a massive disruption to the supply chains and manufacturing, and that's going to have all sorts of spin-off effects. So it's an unnecessary gamble that the Trump administration is taking on. It's not so much the debt bomb, it's the debt servicing bomb. That's the problem. And there's 38 Freedom Caucus members, and we'll know in due course whether or not they're yes men or whether or not they truly are fiscal conservatives. You'd be amazed to see what happened with Barack Obama, what we called the Tea Party back then. Once they took over the reins under Barack Obama, we had a dramatic multi-year decline in the deficit GDP ratio that nobody thought would ever happen with the quasi-socialists in the White House. But Congress, that's where the bills get passed. You would not have believed that you could have had the U.S. government go into surplus in the late 1990s. But we're not going to thank Bill Clinton for that. Maybe Bob Rubin, we can give some thanks, but it was really Newt Gingrich. Congress matters more than the president. When it comes to fiscal policy, we are in a different kettle of fish now than we were with Trump 1.0. Trump 1.0, the deficit was 3% of GDP. Now for 3 years in a row, it's going to be over 6% of GDP. The debt to GDP ratio under Trump 1.0 was 100%, as if that's good. Now it's 130%. And the biggest difference is that when Trump took over in 2016, what I call the government interest coverage ratio, how much our interest charges absorbing out of the revenue pie. That was 8%, pretty benign, and now it's flirting with 20%. So it's like what you look at as an analyst looking at a corporate balance sheet and income statement. What's happening with interest charges in relations to your revenues? It's going up perniciously because the debt is going up, but also interest rates are just staying where they are. They don't seem to be coming down, at least the Fed's not cutting them on a near-term basis. The experience in other countries, and I'll take, once again, Canada, almost defaulted back in the early 1990s. Can you imagine that? At that point, a G7 country defaulting. Canada came within a whisker of a failed auction in 1993. I don't think a lot of people know that. If it happened in the United States, it would be front page news. When that debt service ratio gets into that 25 to 30% range, what happens is that the deficit becomes structural and intractable. And that's when investors really wake up to default risk. We're not there yet. If left unchecked, however, we'll be talking about this before Trump's term ends. So in the next 4 years. So it's not just the debt bomb. You can have a debt bomb like in Japan, but when rates are close to zero, your capacity to service that debt is reasonable. We don't have that situation in the United States. The debt service ratio is going up inexorably, and there's no attempt to curb the debt. And now the Fed is not playing ball. Jay Powell's got 1 year left in his term, and we'll see what Trump does with the next chairperson. But remember, it's the entire Treasury curve, not just the Fed funds rate. The Fed does not control the whole curve. It's complicated, but I think if you're going to ask me what the one metric to pay attention to is the debt service ratio. I've been bullish on gold for years. We put out a special report a year ago saying gold was going to get to $3,000. And once we get there, I'll reevaluate. I still think there's upside. I am most impressed that gold has done this with this ripping bull market in the US dollar. Because remember, the gold is priced in US dollars. It means that gold is hitting even bigger highs against all the other major currencies in the world. That's a big story because when gold is going up in every currency terms, including the greenback, it's telling you something important, which is that gold is no longer trading as a commodity. It's trading as a currency that is no government's liability. So you can say the same thing to me about Bitcoin. I don't own Bitcoin. I've not been advocating it because I'm a conservative individual. And to me, Bitcoin is more correlated with the NASDAQ 100 than it is really with hard asset. It's a hard asset currency, but it trades like the NASDAQ 100. It's gold with 20 times the volatility. And there's only so much volatility I'm willing to stomach. I'm not 20 years old anymore. So gold, I think, is going to do very well. Imagine what it does if the US dollar ever cracks. Look, as I say this, including treasury securities, other safe assets to have as a hedge in your risk on portfolio as a ballast. I think that at some point, the US dollar bull market will break. At some point, the Fed will start cutting rates again. I think in the second half of the year, they'll be cutting rates pretty hard, and the dollar will end up coming down. At that point, the tariff file hopefully will be behind us. That's one of the things propping up the US dollar. Just imagine if the US dollar goes down, where gold's going to go. So I'm very bullish on bullion. And the gold miners, by the way, the gold miners, which have lagged woefully behind. Warren Buffett is sitting on $325 billion in cash. The world's value investor can't find value. But I agree that there's not a lot of places around the world you can find value. Gold mining stocks, way underpriced relative to the price of gold right now. So something to put on your radar screen. I think that we'll look back, 2022, we had a cyclical bear market in equities. The bond market was behaving badly because of inflation, but you couldn't be in cash because it was zero. What if we have another 2022? Now you're getting 4.5%. I think we'll look at 2025. If you bagged 4 to 5% this year, you're going to be a very happy investor. And cash with no duration risk and no capital risk is giving that to you. So I would say, firstly, 60-40. Let's say 60-30-10. Let's say you're investing in a hedge fund. The hedge fund could be net short or it could be net long. I think that I'd want to be in an actively managed hedge fund that isn't market neutral, that can actually short the market. How do you treat that? How do you treat the 60 in that 60-40 or 60-30-10? How do you treat that if an equity hedge fund is in there and it goes net short? So all of a sudden it's not 60, it's 50. And actually I would advise people out there to seek out non-market neutral equity hedge funds that can actually short the market when it's a certain skill to do that. But in that sense, I guess I'm answering my own question, which is that I think you want to take a more sort of eclectic and broader approach towards 60-40, 60-30-10. I've always said that, but I haven't abandoned it totally, but I can understand that there's other things. We talked about gold, for example. 60-30-10. Where would gold fit in? Where would alternatives fit in? Bitcoin is viewed not just as a currency, but as its own asset class. And Donald Trump's reinforcing that, but it was happening anyways. So where do you put that in your bucket? It's not in your 60-30-10. And what about the fact that I think that in this world of uncertainty and the world of debt, it was the very first question, what do? You want to have in that bucket hard assets. You want to have commodities. You want to have uranium. You want to have farmland. You want to have base metals. You want to have real assets in a period of heightened uncertainty. Could be deflation, could be inflation. The one thing we do know is that the big instability comes down to one of those questions, which is government debt globally. How does this end? Will it end in our lifetime? Maybe it ends in our children's lifetime. You will want to have hard assets. I think that you want to expand your horizons beyond just stocks and bonds. I think you want to include cash. Okay, cash is no longer trash. I'd be owning treasury bills. When we talk about 60-40, it's where's the 40? Maybe the 40 is not just treasuries, but maybe in high quality, high yield bonds, or maybe Ginnie Mae bonds at 5.4% pay you right now what you'll get in the investment grade market. So 60-40, I'd add 10% cash in there, probably more. I'd want to follow Warren Buffett and sneak in hard assets into that portfolio.